I think that long-term China is going to be fine. And I think Mr. Rubenstein said that it had been growing at 10% for years and years and years. It's unrealistic to think that's going to stay at that rate, and that's consistent with what we've said. When I started looking at China, China's nominal growth rate was 15% GDP in 2010. It was 10% real and 5% inflation. Now it's 5%, 7% real, 2% deflation. It's basically been on a 2% per year negative ratchet down each and every year for 5 years. I see no reason why that won't continue. Again, we're the law of diminishing returns. The first international airport in a region is a boon for growth. A second one is questionable. Third one is folly. And we're between the second and third, to just use this analogy, in the way China is basically continuing to just throw money at fixed asset investment. And again, that's the problem. It's the model. The model, despite all of what the China bulls saying that they are reforming to a consumption-driven economy, in 2009, household consumption was 37% of GDP. 2010, it was 38%. It's just not happening. And so this is the problem. People say it's happening and they give lip service to it, but the data doesn't support it.
Now, the data that we're getting out of China, or the data that you believe is the truth? Because in the past you've said you don't believe you do not believe a darn thing that they put out there. Well, so have you changed your view in any way?
No. I'm using their numbers. So
you're now believing their numbers?
Well, I'm just saying, using bad apples to bad apples, Stephanie. So it's not going to be any different methodology. And if China is saying we're going to consumption, and even they're saying it only went up 1% in 5 years, I think we're on pretty safe ground to say it's not really growing.
Is their stock market reliable enough at this point that you can play? I mean, it's what you do. You go short. Many people this summer simply said, the rules in this game are changing at such a rapid pace. Doesn't matter what my view is. I can't play anymore.
Yeah, we've not been long or short Shanghai at all in 5 years. I think the Shanghai market is completely detached from the economy in China. It's a retail market. It's a heavily leveraged market. The government is now heavily involved, as you point out, since a year ago, in both pushing people into it and then sort of botching failed rescue efforts this summer. We'd rather look at either stocks that trade related to China in Hong Kong or elsewhere in the West, or just simply in companies that are involved trading with China. But playing the Shanghai market is like going to the casino.
We want to check on the Bloomberg here. Matt?
Yeah, I just have an interesting chart I've been looking at on capital flows in China. I should say capital flows out of China. This is an estimate that we put together on the Bloomberg by looking at FX purchases and then tracking inflows through those. You can see this is I should have put a zero line here. It's right about here. So you can see we started getting outflows back in 2011, and they got steeper and steeper. And now into 14 and 15, we're down big. Is this one of the problems, you think? Are people losing faith? Because you have been preaching this since 2009. So I think people started buying your argument straight off the bat.
Well, I think China has a hot money problem, and I think your chart is indicative of it, and that's why they sort of panicked, in my view, in August when they unrolled the yuan depreciation policy and then sort of had to backtrack so quickly.
Why is it a hot money problem? If you actually look at the amount of potential consumers in China, if you look at the sheer volume of their population, there's many investors who simply said, once we can unlock that market, there's tremendous opportunity. I mean, we've heard Stan Druckenmiller say that over and over. Now, those same investors have gotten burned in the last few months, but it doesn't necessarily change their outlook of the potential there.
They're not inconsistent, Stephanie. I'm not saying anything about Chinese consumers. What I'm talking about are Hong Kong, Singapore, and Western investors who went and borrowed in Hong Kong dollars and put the money into China, usually in high-yielding paper, so-called wealth management products, shadow banking assets, yielding 12, 15%, borrowing at 6%, earning 12 on the so-called carry trade, and then assuming that the currency would appreciate as well as an extra little bonus. Those flows are tremendous. And when China indicated that it might be thinking about depreciating the yuan to help exports or manufacturing, that money has begun to panic, and thus Matt's chart.
Then what's the trade in China to do?
I think typical investors should just avoid China as an investor. Trade with China, be a tourist in China, but don't commit your capital there, and that's the problem.
What's the trade?
Well, in terms of.
So you're saying don't invest, but trade around? Where do you want to trade around?
Well, again, I want to be short. I want to be short commodities. I want to be short Macau. I want to be short a number of things that are affiliated with
short commodities and Macau.